So what we're going to do today is look at the transactions, and up into the stuff we did for chapter 1, we gave you all the numbers in the accounts. Okay, here's all the numbers, and we filled it into the financial statements. Well, transactions are how you get those numbers. So, for instance, if you make a sale, if you sell something, how does that change? Well, someone gives you cash, so your cash changes, and you have a thing. Revenues go up, and so it changes the accounts change that way. So transactions are anything that changes the accounts. And so we're just going to kind of go through a basic one today. This shouldn't take more than, I don't know, half hour, maybe a little more. But we're going to go through and see how it changes our balance sheet is what we're going to look at today. So hopefully you guys have the hand. Well, I should say that differently. Is there one that does not have the handouts? If you don't have them, they're in. If you go in Blackboard in the course files, I think it's course files. Maybe look and see.
You sent them in the email as well, correct?
Correct.
This morning.
Yeah, the chapter 2 ones. Yeah, some people have trouble with their email. It's still an ongoing thing here. And I have a weird one that whenever I respond to something, it deletes the email, which is fairly annoying because you got all these meetings and you respond, you're going to come, and it immediately deletes it. And then if they send you an email after that, it's still deleted. So.
Gotta love technology.
Well, and then they look at my account and they say, "Oh, it shouldn't be doing that." I know it shouldn't be doing that, but it is.
Oh, really? It shouldn't.
Yeah. Well, someone should tell it that then. All right. So today we're going to do is the PDF file is a little bit different than the other one, and the reason being is that I'm trying to create these so that we can fill them in right in the document itself. Hopefully it'll be a little bit easier for you guys to do them and then also to submit them. You don't have to copy or scan or take pictures or whatever. Okay, so I'm going to pull up my... All right, so again, this is the Word document. If you're in the PDF document, it's going to be a little bit different, and the page numbering in this is going to be different too. I put these all on one pages, whereas in the PDF file I have 2 on one page. So these numberings come off of the PDF file, and that they're 1A and 1B are both on the same page. They're exactly the same thing. It's just that they're the format's a little bit different, just so it's easier to fill in. Put my camera here for a second. All right. So you see, we get these transactions. We have our balance sheet set up, and we're going to see how each of these transactions affects the balance sheet. All right. So we used cash to purchase land, $300. All right, what's going to happen to our cash?
It's going to go down.
Oh. And what else is going to happen?
Is land going to go up?
Yep. All right, so in one of the things you'll notice as we go through here, because the balance sheet, they have to balance on both sides, you'll always have at least 2 transactions. You might have more than that, but you'll always have at least 2 transactions. Because if you just change one account, it's not going to balance. So there's always going to be, sometimes this is called the dual entry system. Okay, so our cash would now go down to 700. Accounts receivable would be the same. Supplies. And our land would go up to 1,800. Add all those up. It should be the same number because it's on the you plus 300, or you minus 300 assets and you plus 300 assets, so it should be exactly the same number. Yeah, same number. That was predictable. Yeah. And these over here, you probably don't need to do these. These are all, nothing has changed over here. These would be exactly the same. You don't have to put these in, but these would all be exactly the same. So here's our transaction that we had. Bold those. Can we bold these? I'll make them better. Well, they are bold. Okay, so there is what happened. So these are the transaction. This is a transaction. It reduced our cash and it increased our land, and that's it for that one. Okay, let's go to 1B is on page 2. If you're using the PDF form, it's on page 1 still.
Can you scroll up back to 1A, please?
Mm-hmm.
Thank you.
You're welcome. And just going to give you guys a heads up, what's going to happen is eventually we're going to learn how to do what they call journal entries. And instead of using all these accounts, we're just going to grab the 2 accounts we need and record the transaction. But no, it's good to see what it does overall to the financial statements. And you kind of need to know this to make the journal entry.
You can scroll down now. Thank you.
And this one's very similar to it. Paid cash for equipment. Well, it's kind of the same transaction. Your cash is going down, and your equipment. I'm gonna make that in. Your equipment is going up. Right? Okay. What would that be? 46.90. Again, it should come out to be the 14,560, I think, because because everything's done on, it's all on the asset side. If you add 400 or subtract 400 and then add 400, it should be the same number. But just to make sure. Oh, yeah, with a different number. Let me try that again. Okay. Second time I got it. And these over here will be exactly the same. You don't have to put, you can, this is just, put that in there, but it, well, one of the inefficiencies you can kind of see in this way we're doing it already is that the, putting all these accounts in is that it's not really necessary to look at all the accounts when you're looking at a transaction. This transaction, crazy there. This transaction has nothing to do with accounts payable, mortgage payable, anything like that. So, these accounts are really not affected by any of that. So, what we're going to do in the future, and by the way, this is all stuff that's kind of evolved through hundreds of years of people doing accounting, is that they said, okay, look, we don't need all these other transactions. We really just need to look at these, whatever 2 or 3 accounts or whatever are going on. Okay, this is a little bit trickier one. Supplies are purchased on account for $200.
So your accounts payable would go up by 200?
Exactly. Yes. And accounts payable go up. And so we say, well, wait, accounts payable is you owe people. Shouldn't that be a minus? No, you owe people more now. So you're owing them an extra $200. I should put a plus in front of that. So you actually owe more money now to people. And what else we get? Supplies went
up.
Yep. And you'll notice we're still going to be in balance because we're adding 200 to the supplies, but we're also adding 200 to the liability. So it should be, this is still balanced. $200 more than that. So I think it should be 1380. Check. All right, and let's see if it comes out right. All right. Yep. So 1380. Over here, now our accounts payable was at 1380. It's going to go up by 200. So it's going to be 50. Oops. 50. 180. So notice we own more now. And this is one of the things that people a lot of times have trouble with, is that when you borrow more money, your accounts payable, your liabilities go up. Yeah, you owe more money now. Hopefully they're the same on both sides. Yep. Okay, so again, and you notice these transactions, that this one especially, that these other accounts, you don't need them really. I mean, if they don't change, there's no reason. So again, we're gonna figure out how to do this. Just taking, in this case, it'd be supplies, right? This would be what we don't even need the supplies account and the accounts payable to record this transaction. That's really all we need. Yeah. I mean, to get the total balances, we need all of them, but if we're just going to record the transaction, okay, 2B. What do we do with that? We take out a $3,000 mortgage, and we got a building for $2,000 and paid $1,000 for the land. Hey, this is messed up here. It's not letting me fix it either. Oh, well. Are they all like that? They are. Okay, well, we gotta fix that in somewhere else. Okay, so what are we gonna do with this one? Let's see mortgage first. The mortgage is our liabilities going up or down?
Would it go up?
Yep. So we owe 3,000 more. Highlighting. So our mortgage payable goes up by 3,000. Now we got a building for 2,000, which seems very reasonable for a building. All right, so 2,000. Oops, let's try that again. So our building's gonna go up by 2,000. And our land will go up by 2,000. No, our land will go by 1,000. Like that. Okay, so you can kind of see these are really the only three accounts we need for that: building, land, and mortgage payable. Those are the only ones that we really needed for that transaction. Okay, so let's take a look here. So this is the okay, 6,400 plus 2,000 is what, 8,400? Okay, let me make sure I didn't put that. So plus 2, plus 1. Okay, so my guess is this should be add 3,000 to it, 20,000. 20. Let's check and make sure that that is what it comes out to. The reason I'm adding these up here is make sure you don't leave anything out. And if it doesn't balance out, you probably left something out. Okay, that one adds up. All right, so coming over here. 800 plus 3,000 is what, 7,800? And hopefully that comes out to be the same. Yep. Okay. Yeah, so that would be our, the new balances in our balance sheet would look like that after the transaction. Borrowed cash in the bank. A mortgage payable for $5,000. This is bothering me, this one. I don't know why that is like that. Check the spacing on these. All right. So what accounts do we need?
Would it still just be mortgage payable goes up 5,000?
Yep. So mortgage payable goes up by 5,000. We borrows, we owe 5,000 more. And what else?
We're okay. Would cash go up?
Yep. Yeah, and so you look at this and they say, well, wait a minute, we owe 5,000, that'd be negative. No, your cash went up. You borrowed the money. Now you have to pay it back.
Borrow cash.
But yeah, your cash when you first sign the the mortgage or loan or whatever is going to go up by the money you borrowed.
So every time it's a payable, it go to cash.
No, not necessarily. It depends on what you use it for. For instance, it could be that you got cash like in this one, but I think for this one, for instance, we borrowed the money and we got buildings and land for it. And on this one up here, we got it for supply. So you can borrow money for a number of different things. But if you just borrow it, if you borrow cash from the bank, this is just, you got cash back for it. Whatever you got for your mortgage payable. Yeah. So yeah, but it is when you borrow money, the liabilities are going to go up. And whatever else goes over here on the asset side is just whatever you got back for it.
Okay.
So if they give you cash, if they give you, supplies, but whatever it was, that's what you're going to, that's the account you're going to use. It's probably 28,520, but let me make sure that it's the right number. And by the way, the reason I just typed that in is because we added 5,000. If you know, if you're going to come down here and say, okay, plus 5,000, right? That's probably going to confuse people, but that's not really the transaction. But you know, if this was added as 5,000, you would just add that in. But I'm going to go through and check and make sure that I got everything in there right. Yep, that's right. Okay, coming over here. Uh, 6,300 plus 5,000 is 11,300. Hopefully that comes out the same. Yep. Yeah, and again, you know, we'll talk more about this next week. But the you can see the cash is going up. They borrow more money. They owe people more money now. But really, if you just want to record this transaction, you could just said cash plus 5,000, mortgage plus 5,000. Right? I mean, that's really what happened. You wouldn't know the balances if you just wrote that down, but you would, you know, that would be actually what the transaction was. Oh, this is a little bit trickier. This is issued is the same thing as saying sold. They issue stock, they sold stock. Didn't mean to put that in capitals, but I think I'll leave it. Maybe it's so when you say issued, that's the same thing as saying sold. Common stock for cash. Okay, so this common stock down here now, this is the owners, and obviously the cash is up here. So we sold common stock for cash for $2,000. Let's see the cash. Cash is gonna be the easy one. So we sold the stock. We got cash. So our cash went up or down. If you sell something, what happens to your cash?
Goes up.
Up. Yep. So our cash went up by 2,000. So this is what 30. Well, I'll do that later. The other part of the transaction, we'll go over to common stock. Now, this is where it gets a little bit tricky. So we sold the stock. So this is we're selling ownership in the place. Do we have more owners or less owners now?
Less?
Actually, more.
Okay.
Because you know now there's $2,000 more of stock out there somewhere. We don't know who we sell it to, but
Okay.
yeah. Okay, so we'll see. All right, so 1,700 plus 2,003. That should be 2140. Let's check and make sure. Okay, 21,000. And you kind of knew that at 20, if you had 2,000 to the side, obviously it's just going to add 2,000 total here. Okay, over here, everything is the same up here. Common stocks, we had 11, so what is that, 3,090? All right, so hopefully this will come out to balance. $21,040, that's what we want. Yeah, this is a tricky one though, because issued means sold, and now there's more people that are owning the place, so it's kind of it's a tricky one. Yeah, and it's a weird concept because it's a business plus, it's like with no owners now. Yeah,
I have a question. So if you sold stock, how would your equity in stock go up? Like, how would it be plus 200 or 2,000 in common stock? Like, if you sold stock for cash?
yeah, it'd just be like this. You have more stock outstanding, you have more owners, and your equity section would go up.
Okay.
Yeah, and you just kind of see that, so on this side it would be plus, the total would be plus 2,000, and it would also be that over here, they have to balance obviously. So yeah, the ownership goes up. It is kind of strange. This is a business. They're not selling a product. They're actually selling their ownership. So it's a little bit different of a transaction. For most companies, this doesn't happen very often, but it does sometimes. So yeah, more. They think about it this way: they have more owners now. They had 19 or $1,190 of owners. Now they got 2,000 more. Okay. Or a received cash from a customer previously billed for 500. Well, let's take the easy one. Cash went up or down?
Up.
Up. Okay, so the cash went up. Now, it was for a customer previously billed. So it was somebody that owed us money. So what account is when people is that for people that owe us money?
Would someone said accounts receivable?
Yes.
Okay, that's what it would be. Oh, there it is right there. I didn't see accounts receivable. I was looking by accounts payable. I was wondering where it was. But yeah, that would go down.
So someone said, I didn't hear it. I got to do some of my let me turn up my
No, they put it in the group chat. In the little chat box.
Yeah, little chat box.
Oh, I see. I see. You know what? I'm in screen. Let me see if I can click on it. In screen sharing, they don't let me see those.
Oh, really?
Oh, here it is. No, I pulled up a separate window. Yes, accounts receivable. Yes, I'm sorry. Okay, now I have it up there now. I'll just minimize this. Thank you guys for letting me know. Oh, no, I lost it completely. Darn it. Okay, yes, accounts receivable. Now they just paid us, so they don't owe us $960 anymore. They just paid 500 of it, so we got to take 500 off of accounts. Yeah, so that's it. So the previously billed me accounts receivable. Let me take that in there. Oh, it's gonna goof up my space. That's fine. All right, so yeah, so our accounts receivable will go down now. They owed us this money. Now they paid us. Our cash goes up by 500. Our accounts receivable goes down by 500. So now we're only owed what, 460. It is the same. And this number should be the same. It'll be this plus 500 and minus 500. So it should be exactly the same total. It is 13,440. Okay, and these are all the same. You don't need to type all these in. Besides, exactly, nothing's changed on this side. I'm not going to add those up yet because they're on this. It's already been added up. Okay. Okay, just so you guys know, in the chat thing, I realize that there's a thing that adds on up at the top of my thing, so I should be able to see it now when you do the chat thing. Okay. 4B is the same as the other one. Customer paid cash towards their account, 100. It's the same transaction. Their account would be accounts receivable. I think I put that in. I think I put those two in there because I think that's the wording that the book uses. Okay. So cash is going up. Accounts receivable is going down. And by the way, if this doesn't, if you feel it's it's not making a lot of sense right now, this is the first time you guys have seen this stuff, so it shouldn't, it should be a little bit confusing. All right, so cash is a little. As you go on, it becomes more. The more often you do it, obviously, the more like anything else, the easier it comes. And that should be exactly the same. By the way, the thumping you hear in the background is a little dog crashing against the door. Got a new little dog that doesn't bark. It wants to come in. It like throws itself against the door, so it sounds like someone's trying to break into the house. And these are all the same. Okay. 5A. This is another one that's confusing. Actually, a lot of the stuff with the payables is confusing.
Can you go back up real quick? I ain't see the other side. I want to see how you did that. Okay.
Yeah, so I added 100 to the cash.
Okay.
And then this one 4B is 4A and 4B are the same. I think I did it this way because I think that the book uses both the terminology for both those. So to yeah, there's a lot of different ways you can say the same thing. They paid on account, they paid off a balance, a previously billed balance, and there's a few different ways to say the same thing, and that's kind of why I did that. All right. So 5A is we paid off a few of the accounts payable, $400. All right. Well, what's going to happen with that? Well, first of all, what did they pay? What did they pay with?
They paid with cash, so I think that would go down by 400, and then the accounts payable will go down by 400 too.
Correct. Yep. Correct and correct. Yeah. So they paid off. So whenever you see paid, that's going to be cash. That's a magic word for cash. It's not a magic word, but it means think about cash. What'd you pay them with? You paid them with cash. So whenever you see paid, think cash. So they paid out cash. 400. And they no longer owe $26.40 for accounts payable. They just paid off 400 of it. So accounts payable will be going down. So when you take out a loan, your borrowing goes up. You owe more people. When you pay it off, that's how it goes down. So the only way that these accounts payable are going to decrease is if you pay them. So this is paying it 400. Yeah, so your cash goes down, your accounts payable also goes down. So now we owe less. We only owe whatever it's $22.40. Okay, let's see. Now this side should be $400 less, so this would be 24. 240. Better check that. Okay, so $24,240. That is right. Okay, so over here we subtracted 400 off that, so it's $22,40 for the accounts payable. Mortgage payable, everything's the same. Hopefully this comes out to be the same number. I did it wrong. And start over. Only 4 numbers. I don't know how I goofed that up. There we go. No, it's still off. Why is it off? I did something wrong. Ah, right here. Here, look at that. See what I did wrong there? 13,860. I put 13,880. See, that's why I add them up. So when I do stupid things, I can find those stupid things that I do. So it's 24. Okay. All right. And 5B is kind of the same. Made a payment towards mortgage payable. So we made a payment of 1,000. So our cash is going down by 1,000. Here's a priority done with this one. And our mortgage payable is also going. Also, if I made a payment, so what do they pay with? They pay with cash. So when I receive payment, think, cash. So I made a payment, and they paid it on mortgage payable. So now they don't owe 4,200. They paid off 1,000. Okay. Imagine that should be 14,680. All right. Head those up. Okay. Yep, that one adds up. So it's gonna be 1680. Yep. 14,680. Okay, I think that's it, right? Yeah. So, yeah, you kind of say, so recording these entries, and this is how it changes our balance. And you always have to have at least 2 entries. You can have more. We had that one with 3 with the mortgage, the land, and the building. But you also have to have at least 2 entries because it's got to balance. If you just made 1 entry, there's no way it would balance. So those have to be at least 2 entries. You know, there could be no different combinations on them. But this is you know how it goes. And again, you can kind of see that if you just really wanted to record that entry, you know, and let's say that, you know, we did a handful of them here. Let's say that instead of 10, you had, you know, 130 to do. Well, this would be a real drag to do it this way. So you'd probably say, okay, I'm going to come up with a way of simply taking the, you know, a couple of accounts I need, cash, mortgage, payable, jotting it down. I'll add them all up later, but I'll just jot them down. That way I'll record the transaction. I know what happened with it. And then at the end, you know, we can figure out where the balances are. So, and that's what we're going to kind of do next. Eventually leading up to what we call journal entries, which is, you know, kind of funny because it literally became a kind of a condensed way of writing down something, of writing down basically this. But in a quicker way to do it. Any questions on this? Okay, well, that's it for today. Don't forget that today is, I know most of you've already turned it in, but the